Welcome everyone. Tom Staub here, founder of the Real Estate Investing Academy. Today we have a very special guest, very accomplished Mr. Miky Eby. He's the tax partner of RKL, a tax firm in central Pennsylvania with about 300 employees. He is an avid real estate investor, firmly believes in the asset in that vehicle to build personal wealth. He is the president of Hope Ministries, a nonprofit, and he was just named 40 under 40 in central Pennsylvania. So the guy's doing great things both on the for-profit side, the nonprofit side. And so today we're going to pick his brain on some tax strategy, why he likes real estate, what drew him to real estate, and just what he's up to today. So look forward to seeing you there, and let's get started. All right, everyone. With me today is Miky Eby. Is it Michael or Mike?
Yeah, you call me whatever you want, Tom. But yeah, you call me Mike.
All right. Miky Eby. So Mike and I went to college together some time ago. I won't age us with the dates, but and since that time, he was taking the accounting route. I took the finance route. We separated through different careers to some extent, but I think we're both in similar mindsets in terms of growing personal wealth and using tax strategy as one of the instruments to doing so. And so today I want to bring him on and. Mike, I think recently you were named 40 under 40 in central Pennsylvania. Is that right?
Yes, I was. Yeah, our kind of the regional paper or the business paper in central Pennsylvania, Central Penn Business Journal, every year gets nominations, and they vote on 40 individuals that are under the age of 40 in our region that are doing something in business and also contributing to the community and society through nonprofit work as well. So it was a very nice honor.
It's awesome. Yeah. So I mean, on both fronts, I'd be curious to know. Obviously, you're a tax partner. Why don't you tell everyone where you work and what you're doing there, and then we'll get into the other side as well.
Sure. So I came in as an equity partner to RKL back in 2018. I was previously at another central Pennsylvania firm for 11 and a half years before that. So it was kind of a big move for me. That was my first career move, post college. RKL's we're a relatively large firm in that area. We have a little over 500 employees and 6 offices. And I personally lead the tax service line in 2 of our firm's offices in that region.
Awesome.
So I do a lot of tax planning and advisory work related to entity structuring, mergers and acquisitions, deal structuring related to that, and tax controversy work. But a lot of my work's tax consulting related, but come tax season, I still have to roll up my sleeves and do a lot of reviewing of tax returns as well.
Yeah, I'm sure. I'm actually still waiting for mine. It's pretty complex, but it's it's still in limbo. Cool. So, I guess more on the personal side then. I mean, you're obviously into real estate investing and other types of investing to grow your personal wealth. What are you doing on that front?
So I mean, I would actually probably not what a lot of financial advisors would probably tell you, but I'm heavily saturated in one industry and probably my personal wealth, and that's real estate. I have my retirement portfolio that you've built up over time from work, in a Roth account. So that's in the market and obviously diversified from that standpoint. But I just love real estate. That's even since I was a teenager, I wanted to be a landlord. I bought my first house when I was still in college, and that was my primary residence, and we lived there for 12 years up until actually a couple of years ago. Yes, I for 3 to 4 years, probably post school, I had been casually looking at homes in Zillow and Realtor.com, and getting really familiar with real estate in this area in central Pennsylvania, and kind of trends and pricing. And I never knew if I would actually pull the trigger, though. A lot of risk involved in being a landlord. And one day I saw the right property. I reached out to that realtor that was listing the property, and I actually didn't buy that property, but I then looked at a couple others with him, and ultimately settled on a 2-unit. Pulled out my some of my equity for my personal home, and bought that 2-unit, and that was end of 2012, and now I sit at that 10 rental properties, which
Mm-hmm.
kind of, for now, I don't use a management company to do that. I do it on my own. So I kind of reached the max of where I want to be right now with 10 houses. And so I have a very demanding career from a time standpoint and 3 young children. So I have a nice little platform though. And, and ultimately long term, I'd love to add some more on in the future.
Yeah.
That's certainly what I enjoy and passionate about.
Yeah. What about real estate? I mean, I personally have that, I don't know. It's interesting, right? I bought my first one, I don't know, probably around the same time. And the first one didn't really get me. The second one that I bought, I was like, wow, this is great. And then I just started piling them on after that. Then of course, I think when I started piling them on, I started becoming a little more careless because I was just chasing the number of doors. And so I had to go through a few mistakes. And now I'm in a place today where it's like, I know the exact product that I want, the right kind of tenant that I want.
Yeah.
I have a platform as well that I use to manage. And so what about real estate drew you to it?
Well, I mean, it's kind of to your point. You do learn a lot through the process of being a landlord. And I've, the first few ones, I did not make the right decisions on some things, and you kind of you learn from that, and then you get into a rhythm, and you get better, and then you kind of build out what your ideal real estate portfolio is. And mine's probably different than some landlords. I don't, like, to your point, I don't chase doors. I don't like the multi-units that much. I tend to stick to the single family homes because they're the safer ones typically on the resale.
Right.
They get some appreciation. You're not going to make a ton of money in the operating in the short term, but I tend to get more families in there and get more long-term tenants, and that's kind of the strategy I've gone with, and trying to get them into nicer school districts as well, where you kind of have a nice built-in appraisal throughout time by doing that. But I think why real estate attracted me, I mean, I don't know why I did when I was a teenager or at a younger age, other than I thought, well, hey, getting your own home, building equity, and then possibly having people either live with me at that point. I considered that in college. I realized, well, if this is going to be my family home after school, I don't want a bunch of my college friends wrecking it before living with me. But I just thought, it's a great way to build equity. And I dabbled in the market, early on in my career, kind of doing some short-term trading, and hits and misses with that. One miss was I put a lot of money into solar power during the Obama years because there was a big push for that, and I lost a decent amount of money, and this is the 08, 09, 2010, so there was lots of ups and downs in that market, and I realized the stock market, at the end of the day, there's a lot of paper money there. Companies go up and down, and some companies go out of business. With real estate, even though it was a down market, and we never saw anything like that in 2008 in the country's history. There's still substance at the end of the day. Everyone needs to live somewhere. That demand will never go away in the long term. And you might not make a quick buck in real estate, but there was something to having that in your portfolio that gave stability.
Yeah, agreed. And I tell people the same thing. I've owned multifamily buildings, and I think if you're going to do it, I actually think first, definitely get the experience to do it. Have a crew, because you're going to need a crew to really force the equity and the appreciation. But when I did it, I did it right in that I bought a distressed property, fixed it up, increased the rents, sold it, like you're seeing with a lot of the syndications these days. But the problem is kind of what you're mentioning on the value is only going up as so much as the rent is, right? Because it's a different vehicle, it's a different asset class.
Yeah.
So if you're buying a premium product that already market rents, not much room for improvement, and you're buying at a 5 to 7% cap rate or a levered 12, 13% ROI, which would be pretty stellar actually. Then that's probably all you'll be making for some time. Now we'll get into the tax strategy as to why you might want to consider multifamily. But generally, I'm right with you. Like, in terms of the resale, you have two markets. It could be an investor. It could be an actual homeowner. They do appreciate with the market. So I actually too like single families. I think that's where the market's going long term as well. People don't want to be, living in these small corridors next to each other, unless you're in these big cities. But we're seeing the migration. People are moving away from the cities too. So net, I think you're spot on. I think single family is where it's at, and it's going to be there for some time.
Yeah, and I think you kind of hit the nail on the head there. I mean, these last few months, I think the market demand has changed a little. I think people are going more for the larger homes than they used to the last couple of years, because we saw the trend that was going actually to smaller homes, tons of townhouses, and that was kind of seemed to be the new trend.
Mm-hmm.
And people are realizing, well, we need a little more space if we're going to be working from home.
Yep.
Maybe it's a short term, but maybe that's going to be more long term for a lot of companies. Plus, having a little larger yards, that's now more desired. That wasn't the desire before. Less maintenance was kind of what people were pushing for, because people had less time to take care of the yards. We might be seeing a trend going back the other way to where it was 20, 30 years ago.
Yep. Awesome. I'll just comment too. I kind of was in a similar path with the stock market. I don't know if you want to call it in college. I was obsessed with it, like finance club and all this stuff, but
yeah,
just a geek about it. Right. And, but it took me, the experience of thinking I knew what I was doing with options. After I had won a few, I was like, oh yeah, this is great. And I just, got it wrong one time. And that one time is so substantial.
Yeah.
Where, like, to your point, real estate, even if you lose 10% in a down market, which, by the way, down markets don't really happen in real estate. If you look at, in the last 40 years, for example, we had, and again, it's market to market, but in general, nationwide, it tends to be a recession hedge. People don't move during recessions usually. Rents might go down. So as a rental, you might have some risk, but generally it's a recession hedge. And so '08 was definitely a one-off, but at the end of the day, even if you were to lose 10, 20%, you still have a tangible asset that you can make cash flow from. An option contract expires to nothing. Stocks can, they can go down substantially. And then again, as you said, it's just a paper asset. So I'm with you in that same camp. Segueing into real estate as, within tax strategy, there's been a lot of changes since the Trump, reform came into play. And one that I tell people that if they have an ability to use, I think the ideal situation is where you are a married couple with a single earner and you have the ability to pool losses against your ordinary income via the bonus appreciation, cost segregation, all that. Would you want to maybe give us a high level as to how that works and where you see that law going if, let's say, a Biden wins office?
Yeah, and I think you're referring to what we call the mom and pop exception in terms of real estate. So, if you're filing a married filing joint return and you're making taxable income, and this is your total sources, including what would be your rental losses. If you're making under 150,000 of taxable income, you're able to take rental losses, which are generally passive, and take those against ordinary income. Now, it is possible too in this scenario, like you were describing, where you have one spouse that is working and one spouse that isn't working. That other spouse, if they're focused on the real estate and that's kind of their career, they can be a real estate professional, which allows them to take rental losses against ordinary income, even if their income is well above that 150,000. The reason normally, if rental losses would not be able to be taken against ordinary income because rental losses per se are considered passive. So when you have passive losses, they can only be netted against passive income. Most people don't have a lot of passive income, and passive income does not include your dividends and capital gains portfolio income from a stock market. So, but generally in real estate, and you alluded to a couple of examples of why this is, real estate, you're generating losses in your first few years from a tax standpoint. You still may be cash flowing and very well might be cash flowing, but you're able to break down your real estate into different asset classes. For instance, your carpet could be considered a 5-year asset where you can recover that and take what they now call bonus depreciation, which right now is 100%. You can write off the entire carpet costs. Now, when you're buying a house, you're itemizing it on your HUD of what you're actually buying. but that's where you have to, you could do a formal cost segregation. So paying someone to do it's not going to be the return, but you can kind of take some general understanding of what the value, if you take your overall purchase and break it down, well, how much of this purchase was really attributable to this pretty new carpet, taking that value, and you're able to write that off instead of, if you put the whole asset into place, a building that's residential, it's 27.5 years, not eligible for bonus depreciation. So that's a long time to recover that expense. Mm-hmm. But you stack you break the assets down, you get the bonus depreciation. You're most likely going to get some losses in your first few years. Even if you don't take bonus depreciation, getting those shorter lives of 5 years, your land improvements being 15 years, also eligible for bonus. Land improvements meaning your sidewalks, your driveway, things like that. Also, if you end up replacing those assets, you could write that asset off. For instance, you might have your roof for only a few years. If you broke that down separately and then replace it 3-4 years down the road, you can write off that cost, whatever is remaining depreciable all in the first year. So I can tell you, I've been doing this for 6 or 7 years now. I've definitely made money. I have not paid any income taxes yet on that rental money. Obviously, if I sell one of those units, I'm going to ultimately end up paying, because I'm going to be selling them with a gain because of having that depreciable basis.
Let me ask a clarifying question. So you said if you make under 150, I'm guessing AGI, or adjusted gross income.
It's income before your itemized deductions or standard deductions.
Okay, so if you make AGI. So if you make 150 before your deductions individually, you can take your passive losses. Let's say you have $10,000 in rent, you have depreciation, mortgage interest, and whatever other costs are $12,000. Your passive loss in that example is $2,000. If you make under 150, you can take that $2,000 as a loss against your W-2 income, more or less.
Yeah. So the phase out range is between 100 and 150,000 of AGI. Yep. So really, if you want to be able to take that full, I believe it's the 50,000 or 25,000, of loss, you can take up to 25,000 under this mom and pop exception. If you want to take that full amount, you would have to be under 100,000. But between 100 and 150,000, the phase out $2 for every $1. So as long as you're under 150, you're getting some benefit of being able to take those losses.
So I have this thing, it's Robert Kiyosaki's cash flow quadrant, which is basically the idea you're either an employee, you might be a sole proprietorship, or you are an investor and a business owner. The business owners and the investors have all the tax incentives to make things happen. Employees and the self-employed fund those incentives, right? So here's a situation where the government's actually incenting someone who's kind of getting started, not a lot of income, a decent income, to really take advantage of tax breaks that I personally don't get, right? I have to do another, unique strategies. So if you're starting out, the tax code within real estate seems to be on your side to help you scale up your portfolio. Would you agree?
Yeah. I think you hit it on the button, right? Because with tax reform, so starting in 2018, business owners, and this would include rental, if you're treating it as a business, so rental properties, you're getting a favorable deduction called the qualified business income deduction, which is a 20% deduction. As a W-2 employee, you're not getting that same deduction. So, if it's a W-2 employee making 200,000, or a Schedule C or Schedule E, if they're making a business as a business owner separate, making 200,000, they're essentially getting a $40,000 deduction there. With tax reform. So you're paying less taxes as a business owner. So the same thing would apply for real estate. So let's say if you ever do get into a taxable income situation, currently that qualified business income deduction is on the books through 2025, and that's set to expire. We don't know. It could go longer. It could actually go shorter, depending on the political landscape is very. It plays a lot into what the tax code will be, probably even as early as next year. But when you're making income, as long as you're treating it as a business, meaning when you're paying, you need to issue 1099s to your vendors. If someone's doing a repair for you as a business, you need to issue a 1099. Meet those qualifications. Not too hard to meet. you would be eligible then for that 20% deduction. So that's 20% right off the income that on your return, and that's something an employee does not get.
Yep. Yeah, I'm with you. This is when I tell my clients, when you have enough assets that are producing income, and when you really have to start taking into account tax strategy, which everyone should, because it's the biggest expense in your life, without a doubt. Owning a business and figuring out ways to, I'm not going to put you on the spot here, but figuring out ways to intertwine personal needs with business needs, still at the end of the day, using them for business, and driving as much of your income through the business to write off the expenses is really a great strategy as well. And so long story short, what I'm saying is when the time is right, I think everyone should own a business as well to do some of the things that you're talking about.
Yeah, absolutely. Yeah, I mean, you got to treat it as a business. You got to actually, it's got to be a for-profit motive. And we're not talking real estate. Real estate, I don't think ever gets pulled into this because no one does real estate as a hobby, even though we might like it. We don't, or it's not going to be technically a hobby.
Yeah. But I don't enjoy, fixing a gutter.
Yeah, or toilets or what have you. But yeah, if we're talking a business, yeah, you just want to make sure it's a legit business for profit motive, because if you keep showing losses, the IRS could reclass that as a hobby. So, someone like me maybe wanting to sell baseball cards or something that I like, I better make profit eventually on that, or that could be subject to a hobby loss reclassification.
What is do you know offhand what is the general red flag? I have a business now that lost money in year one, kind of intentionally so, I guess. But going into year two, it might make some money depending. Is it more than 2 years? I think it's on the third year, right?
Yeah, generally you're supposed to make profit 3 of your last 5 years. Now, but that's the general rule. If you can show that it's truly being operated as a business, that you can rebut that presumption. But 3 out of 5 years. So if you generally, that's what we tell taxpayers. If you have 4 to 5 years of losses, be careful, because eventually the IRS could send a notice related to that.
Yep, makes sense. Cool. So I'm going to hit on 1 or 2 last topics here. So obviously there's potentially a political change, and I know Biden came out with a high-level tax plan like last week or so. But so who knows how much of that will actually get passed? But I think you could expect maybe real estate to be a target. But what changes do you think are coming down the pike for people in the next, let's say, 2 years, whether it be Trump or Biden in the office?
Yeah, I mean, you're getting into the crystal ball there.
Yeah, right.
But we have to. I mean, as a tax advisor, we kind of get into that because we have to, decisions we're making now, whether to accelerate deductions, because the overall philosophy typically is accelerate your deductions, take that bonus depreciation, because hey, preserve the cash flow, get the time value of money. But those decisions change if you really believe that the tax environment, you're going to be paying a higher rate than year after or 2 years down the road. Maybe you don't want to accelerate deductions, because that ends up being a permanent tax cost to you then, because you're not taking advantage of saving those deductions for the higher rates. If Trump wins, I don't know if a lot's going to change related to the tax code right now. I think long term, I think we can all expect, no matter who's in office, there's going to have to be changes to raise revenue. The amount of expenditures going out from the federal government this past 6 months is unfathomable. And I think everyone firmly believes that there is going to be tax increases in the long term. I doubt that's going to happen short term if Trump would win. If Democrats were to get in, including the presidency and Congress, I would expect them to attack the tax code pretty shortly into their stint. So as early as maybe 2021, having some of these changes, or as 2022. I think the C Corp rate is going to be probably targeted the most. That went down from essentially the highest being 35% down to 21% rate. I know Biden's thrown out 28%, so bringing it up somewhere in between. Also, the estate tax lowering the thresholds for that to bring more people into a taxable estate. Those are two targets. Those are two targets that are good to campaign on. Will they go after some of the small business, the qualified business income deduction? I don't think entirely, because it does affect the majority of the middle class, but certainly would they lower the thresholds so that people phase out of some of those quicker? I think that's a possibility. I don't know if real estate's going to be a major factor in terms of directly attacking that, other than maybe the qualified business income deduction maybe not being there for some higher earners. Which
I think I think the Biden plan mentioned the removal of the 1031 exchange clause, which would be interesting. Right. So,
and obviously that's been modified already. Used to be able to trade in vehicles and other tangible property, and tax reform took that away. So it's limited to just real estate at this point.
Yeah, it's interesting too, and I guess it depends on what economic camp you're in, but typically raising taxes in a time of a depressed economy is not the right move. You usually want to keep them light, let people spend more or reinvest or create incentives. So it's an interesting move, right? Because I think we can all agree that we got to figure out how to balance the budget to some degree. But I mean, during a downtime, that's probably not in the forefront. So I don't know. We'll see. It's interesting. I'm waiting to see. So we'll see what happens. Cool. And let's just let's close here just on kind of what you're doing on the nonprofit side. I know our schooling and kind of the mantra of where we came from was really about giving back to the community and whatnot. And kind of curious what you're doing on that front.
So one board I've been sitting on for now 7 years. I just was elected president back in July. It's New Hope Ministries. It's a Central Pennsylvania nonprofit, about 7 locations. Traditionally, I've been known for as a large food bank in the area, and that's one aspect that we do. I think what we've become very proud of, and what we've really tried to push as a board and the leadership at the organization, is our stability program, and kind of cut off the cyclical cycle of families needing that meeting those acute needs of food and housing assistance and utility assistance. So our stability program, we have a very good nurses aid program.
Oh, nice.
CDL licensing, forklift, a lot of job training, hosting job fairs. The idea is to be able to bring families to being able to be stable on their own without needing assistance or needing lesser assistance in terms of their necessities. And, someone coming out of the nurses aid program, which is, about a 9-month course, they're making $18 to $20 an hour plus benefits. And, you can certainly, in our region in central Pennsylvania, certainly survive, and not only survive, but be able to thrive a little on that and just be able to support a family. And that's great. And that's a major upgrade compared to maybe they're on an unemployment or, working a job that's less than $12 an hour. But that certainly helps. And what it does, it breaks that cycle for their children as well. And that's the third prong of what that organization does. We have an early learning intervention that we do.
That's awesome, man. That's we talk about wealth a lot, and it's awesome to see a great ROI on a project, but it's probably, in my opinion, it's more rewarding to give back and see the impact of that, right? So that's great. So where can people reach you? Let's plug the firm in case they have any questions. So you're in Pennsylvania. So can you practice outside of Pennsylvania, or is it just
Absolutely. Yeah. I mean, unlike attorneys, we're certainly registered in our state, but I have clients all over the country. I actually lead our state and local tax practice as well. So I'm getting involved in state tax controversy matters in California and Texas and all over the board. So certainly you can reach me at my email address that certainly could be pulled up on the screen. My number is on there as well. Happy to talk through anything with you, or if you want to talk real estate investment, I always love talking shop on that as well.
Awesome, man. Yeah. And and then again, New Hope Ministries, I'll put that in there as well in case anyone wants to donate or help funding on that. And awesome. Well, we should do this again in a few months and we'll go from there.
Certainly, and maybe we'll have some clarity too on some of the tax items.
Yeah, agreed. Awesome.
My heart, when I saw it down, I blame